Welcome to the second quarter 2025 Advanced Asset Management Advisors Market Commentary Review. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, our Chief Investment Officer. Hey, Phil.
Hey, Bob.
How you doing?
Good.
Super. Well, it's another quarterly review and another quarter of substantial volatility in a lot of factors that affect the market. You know, we've had tariffs on, tariffs off, reduced tariffs. We've had down markets, up markets. We've had down GDP, up GDP. We've had a tax bill that's kind of on, then completely off, and then it passes last week. So give us a little perspective on the volatility from your viewpoint.
Yeah, I mean, everybody knows what the market did in April with the sharp decline and then the rebound, and just recently at new highs, at least on the cap-weighted indices. But, you know, looking at the longer term, going back the last 3.5 years, after inflation sort of came roaring back, interest rates are higher. And during that period, we've had a lot of volatility in the stock market and the bond market. In fact, the bond market, long-term treasury bonds still have a cumulative 30% decline over the last 3.5 years. So, you know, the volatility has been elevated the last 3.5 years, and the last couple months is no different. It just has continued.
Absolutely. So what do you think some of the potential opportunities are in the marketplace today, if any?
Well, it's interesting, you know, if you look at this last 3.5 year period, Treasury bills have been almost the best performer, just lagging a little bit behind the average large cap stock. And of course, that's been a very smooth ride. So, you know, you could compare yields available in today's market with Treasury bills, 10-year, 30-year, all about, you know, in the 4 to 5% range. And the large cap stock index at 22.5 times forward earnings is really about a 4.5% earnings yield, which is about the same as available in short-term bills or 10-year treasuries. So the equity risk premium today is pretty much zero. And that doesn't mean that the stock market is going to go down. It just means that T-bills and treasury notes are just about as attractively priced as the stock market. So, you know, it's not a market timing tool, but it could prompt some investors to delay their cash flow into the market, maybe hold it in T-bills for a little while. You know, if you're on a dollar cost averaging program, you might delay a month or two before putting the cash to work in the equity market to see if valuations come back to favor stocks a little bit more.
And of course, if the Fed cut interest rates, it should cause T-bill yields to go down, which would improve it for the stock market, potentially, correct?
Well, versus bills for sure, but not necessarily for bonds, as we saw last fall. You know, when the Fed started cutting with their initial 50 basis point cut, we've seen actually treasury notes increase in yield. They were about 3.80 at the time, and we've been 4.25 to 4.5 today. And mortgage rates are closer to 7 compared to 6 that they were last fall. So whatever the Fed does doesn't necessarily translate into longer term yields.
So we need to get the longer term bond investors to bring rates down a little bit, and then that potentially could cause a better environment.
That would definitely help relative valuations in the stock market. Yes.
Sure. Any more thoughts on inflation, interest rates, and the economy?
Well, inflation we've been talking about for years. It's definitely improved. You look at the Fed's favorite measurement, PCI or PCE core services, which we track on a 6-month moving average to sort of smooth out some of the month-to-month changes. And that had been 5.5. It got down below 3 a little bit, a couple of times in the last year. Currently, just above 3. We've had some monthly prints close to the 2% Fed target, but the 6-month average is at 3%. So inflation has been a little bit stubborn, not gone away entirely or not down to the 2% target on a consistent basis. So more progress required, I would say, in the inflation front. In the economy in general, we started talking last summer that there was a window opening in the first part of this year, 2025, where we could see the economy starting to slow down. We didn't predict a negative quarter in the first quarter, but as we all know, exports and imports, front-running tariffs negatively impacted the first quarter to post a minus 0.5. So, and this quarter, it looks like we'll be back to a positive 2% growth. The underlying strength in our economy, obviously the consumer, about 70% of the economy, is in good shape on an aggregate basis. But with all the inflation we've had over the last 3.5 years, a lot of people are having trouble. In fact, we're starting to see consumer spending slow down. It's not declining, but the last 6 months, this year to date, the average is a 2.25% annualized growth rate over the last 6 months. Historically, that's 6.5. And in fact, there's been a couple months this year, January and May, where consumer spending declined, contributing to that modest 2.2% growth. So underlying strength in the economy is it's hanging in there, but it's definitely slower than what it had been before and compared to history. So some question marks developing. It's too early still to call for a recession, as we've been saying consistently over the last 3.5 years. But under the surface, there are some signs of some slowing.
Absolutely. Why don't we shift gears and talk a little bit about our positioning today?
Yeah, first of all, the easy one is in the income side. We've been in short-term high-quality issues for a long time, initially because we felt that there was a high risk of inflation accelerating from 2019 forward. That, in fact, has happened. Short-term and long-term rates are higher. Long-term bond investors have been hurt significantly, and our portfolios have held up very well in the short-term Treasury portfolio. Until we see consistent improvement in the inflation side, that's going to be our target, unless we see a significant steepening of the yield curve. Don't see that happening at the moment, but we'll have to see how things develop. But for now, short-term, high quality. In the equity side, it's sort of the same story as well, where we have definite leanings towards more defensive sectors, healthcare, staples, utilities, some real estate, and away from or slightly underweight from some of the more cyclical or more volatile financials. We're underweight, for example. So consistent theme that we've had in place for the last several years, continuing. the equity side.
Awesome. Well, thanks for taking time today to go through all these items, and we'd like to thank everyone listening. We'll be back on in the mid-quarter commentary review in a few weeks. And if you'd like to get a hold of us, we'd be happy to chat with you about your clients, our model portfolios, and how we could assist you in helping your clients meet their long-term investment objectives. Thanks again. Take care.
Thank you.